That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
And you're doing it today with me, Don McDonald, because once again, my co-host Tom Cock on vacation, living the good life somewhere. I don't even know where the heck he is, but he's not here. That part I do know. So it's you and it's me, and we're going to talk about money because, well, I'm having a hard time coming up with anything you deal with and you need more than money. So, because it's so important and yet terrifically confounding, in large part because there are a lot of people who would love to get their hands on that money, you might need someone every once in a while with whom you can chat about some of those financial issues and feel like you're not being misled. And for about 3 decades now, I've filled the role of one of those rare people who's not going to sell you the latest hot thing or put you in an indexed annuity. So call me. And now that I want to explain something up front. We do a radio show on Saturdays on Como News Radio in Seattle, the big, gigantic, wonderful news station. And then we turn it into a podcast. So a lot of you around the country hear this as a podcast next week. But this Saturday, today, whatever, what is it? It's the 16th of November already. Oh, wait a minute. Does that mean it's like 40 days till Christmas or something? Anyway, on this show, we're going to be a little shortened today. It's an hour and a half. We have an hour, first hour of the show, 3 to 4 p.m. Eastern, noon to 2 Pacific, and then 1/2 of an hour after that, which means those of you who wait until the end of the show to call, which is most of you, will get to the end of the show and go, oh, it's over. So either call early to 855-935-TALK, 855-935-8255, or if you call late, just go ahead and let it ring and leave a message, leave your question. I'll answer it on a future podcast. Either way it works. And also visit us at TalkingRealMoney.com. That number again, 855-935-TALK. And, I really like getting the book out there. So if you call, ask a question, we're out right now, but we got some more on order. We'll get you a copy of my book, Financial Physics, which is an easy read and will help you understand how money and investing works a lot better than you probably do today. So give me a holler, 855-935-TALK, 855-935-8255. Now Tom and I are big believers in what is called the efficient market hypothesis, which means that most of the information on which markets trade, stock markets, bond markets, commodities markets, whatever the markets are, securities markets, is already known to most people. That the market is pretty darned much efficient. Totally no, it's not totally efficient. And for that reason, every now and again, somebody out there stumbles on something that allows them to wallop the market. And one of those somebodies was written about in a new book called The Man Who Solved the Market. Now, this guy, Jim Simons, runs a firm called Renaissance Technologies. It is a hedge fund. He is 81 years old. He is brilliant. He was a code breaker for the U.S. He is a mathematician and one of the best. He created a program, they call them algorithms, for predicting which stocks would do well and which stocks wouldn't, and he offers it to wealthy investors in his hedge fund, Renaissance Technologies. How has he done? This is to prove that the market is not entirely efficient. Yes, people can beat it. His 30-year average annual return has been 39% per year. That is almost twice the average annual return of Warren Buffett. And what makes that even more astonishing is the fact that that return is after fees and expenses that you will not believe. He charges 5% per year on the money invested in his fund, and this one shocked me. He also takes 44% of any profits. And yet his investors still made 39% per year. However, the author of the book, a gentleman by the name of Zuckerman, said toward the end of the book, for all the unique data, firepower, talent, trading, risk management expertise they have, they only profit on right about 50% of their trades, which shows you how challenging it is to beat the market and, quote, how foolish it is for most investors to try. So, you're not special enough, I guess. We'll be back.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Oh, and by the way, I was just talking about the Renaissance funds, Renaissance Technologies, where they made 39% per year after a 5% annual fee and 44% of the profits. If you're thinking, hey, you know what? I'll pay 5 and 44. I want in. Yeah, no. You got 20 million? Yeah, it's minimum. Good luck. You're going to have to settle for the same returns as the rest of us. There's just nothing for us. So apparently there is a special product for special people. But again, the man is 81 years old, and who knows? Who knows? Who knows what would happen after? We just don't know. We can't predict the future. It's impossible. So I just believe you're better off, rather than getting ripped off by somebody who says, oh, we're just like him. There are lots of those who claim high returns and then have ended up Madoffing you. I like it better than Ponzi. It sounds better. It's a Madoff scheme because they made off with my money. Forget it. It's not going to happen. Just take what the market gives you. 855-935-TALK is our number. By the way, taking what the market gives you is still better than what most people have ended up getting in the past. 855-935-TALK is our number. I'm Don McDonald. Tom on vacation here on Talking Real Money. Jeffrey, you are up next. Welcome to the show.
Well, I appreciate you having me on. I sure don't have 20 million to throw out there, but I have done pretty well over the last 15. Yeah, me too. I do have a little nest egg, not a nest egg, but I've had some money that I've done for the last 15 months, and I'm looking to get out of it here and just go ahead and pay that 15% capital gains tax on it. And you know, with our climate right now, I'm a little nervous about equities, and so I was looking for maybe a place to park this for the next 12 to 15 months. Let it sit there, hopefully not lose any money, but certainly maybe grow at maybe 3 to 5%. Would love to hear your thoughts on that.
Well, I will give you my thoughts. Stay on the line, though, because I want to ask you some questions. First,
okay.
How long have you listened to this show?
Well, I'm probably only about a year now.
Okay, because we've been doing it for a while. I've been doing a version of it for 30 years. And probably the most common call we get is one like this. The market feels too high. However, I can tell you that I have been getting this call regularly year after year since 2009. Because every year the market feels high. And then what people do is, like in 2018, they go, oh, I should have gotten out before. Now it went down. Remember last year when it went down?
Yeah, I do.
What did it do? What did it do this year?
It went back up. Fortunately, I got out last. I got out last August, and was able to get back in February.
But here's the problem.
I understand the historical.
Here's the problem: is that when I go back and look at the best days the market has ever had, many of those best days happen in those periods when people are out of the market. And so they are reducing. This is one of the reasons why the average annual return for most investors is so sad, because they miss those best days. And I spout off all kinds of figures. You miss the best day, your return drops by X percent. I don't have the numbers here in front of me, but those are actually true. Here's the reality. The reality is that you will at times come close to being right, but unless you're 100% right. Because of the fact that rising stock markets, annually rising stock markets, outnumber falling markets by 3 to 1, it's 75% rise, 25% fall. If you're out 25% of the good markets, you haven't done yourself a bit of good. Sure. And all you've done is incurred a bunch of costs and taxes. My advice has been for 30 years, I'm telling you, I've not changed my tune, that you put your money in a properly diversified portfolio for your tolerance for risk, and you just stop trying to predict what is an inherently unpredictable thing, the future. You can't do it. You may get out and you feel like, I got out pretty close, and I got in pretty close. But again, if it's 25% off, there's no net gain.
Sure.
So I wouldn't do a thing. My advice is not to do a thing. Discover what your true risk tolerance is, your psychological profile, and then build a portfolio that has enough in safe stuff and enough in riskier stuff and is massively diversified so that you don't have any risk of any one or two things taking your portfolio down to nothing, or that portion of it down to nothing, and then go about your life and do the things that you're best at. That's my ongoing philosophy. Okay, Jeffrey? Okay,
well, I appreciate your time. I'll hang up and continue listening.
Thank you, sir. I appreciate it. Take care. 855-935-TALK is our number. 855-935-8255. And Glenn, you are up next. Welcome to Talking Real Money.
Great. Thank you for having me on. I got some asset allocation questions. To just give you a little rundown of my pots of money. I've got $435K in a regular IRA, about $475 in a Roth, and then I've got $400,000 in non-retirement taxable type accounts that I intend to basically use for retirement and various other things.
You're going to use those assets first, and then tap the others in logical order, starting with the IRA and then the Roth, because the IRA you have to start taking at 70.5. Am I right?
Yeah, exactly.
Cool.
Basically I'm 50, well, I will be 59 in January. And so in about 6 years, what I'd like to do with the regular IRA is basically purchase immediate annuities on that money. And then I don't want to take Social Security till 67. But
hey,
so I'm wondering...
Can I throw a thought in real quick? Quick thought. With the kind of assets that you have, wait till 70 and let your assets fund you, because if you wait, every year you wait, you increase your check by 8%. Unless you're making 8% on your money, you're better off drawing down your taxable account to make those income pay, to pay you that Social Security income. pay yourself the equivalent of whatever Social Security would be at 67 and then let it ride for 3 years so that you get that dramatically higher amount. Because it also, are you married?
No.
Oh, okay, then never mind that part.
No, yeah, no, never married, no kids.
Okay.
But, so, okay, I guess I kind of get that, but I don't think 400K is going to go for, you're talking 9 years.
What's your Social Security benefit going to be at, hang on, hold that thought for a minute. Think about what's your Social Security benefit going to be at 67? Because let's talk about that and the other issues. The 400K, no, it may not last you, but you can always take some of the money out of that regular IRA too if that won't last you. But we'll come back to the bigger question and then this little question in just a quick moment. This is fast.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor is a fiduciary at TalkingRealMoney.com.
Your dives to a really great financial future. Tom and Don are talking real money.
All right, Glenn, here's what we're going to do. Hold on to we're going to skip the Social Security for now. Let's go back to your main issue. You got $400,000 in a taxable account, $475 in a regular IRA, or $475 in a Roth IRA, and you're going to retire when?
Well, that's the $24 question. I basically have work till I'm almost 62, and then my company is going away, and at that age, the likelihood of getting a job is not very good, and so I will probably have to retire or maybe get part-time work, after that. So it'll probably be just in a few years.
Now, what kind of, have you sat down and calculated what it's going to take, how much income you're going to need at 62, assuming you don't get a part-time job?
I spend, I know exactly what I spend because I track every penny. I'm a little bit obsessive, actually, and I do nothing.
That's a good thing. All right.
So I basically spend $36,000 is out the door, and that's actually there's a little padding in there.
Okay. So $36,000 a year is what you want to generate at age 62. Roughly?
Yes.
Am I right? And is that after or pre-tax? That's after?
That would be, that is after tax.
Okay.
But I don't think there's that much, the taxable amount in the taxable account would not be all that. It's just some capital gains mostly.
You're not going to be in that bad a bracket. Here's what I'm thinking. And again, this is where I believe that this Social Security thing is just so flippin' sacrosanct unless you absolutely have to take it. I really think almost everybody, unless you have to take it or you believe based on family history that you don't have 80-year-old longevity in your genes, that you would be wise.
Very long longevity.
Then you would be even more wise. I'm serious. We've run these numbers. Take the 475, take the 400, and from those, pay yourself about 5% of the total assets at the beginning of the year every year. That will give you your $36,000 after taxes. Then what you do is going forward, if your assets decline slightly in value the next year, well, you tighten your belt a little and you live on $33,000 or $30,000. If the assets go up, you take a little more out and you either enjoy yourself or you put it aside for a rainy day year down the road. That is only going to be 8 years that you have to do that. By most every scenario we've run, and we've run these Monte Carlo scenarios, all kinds of things, there has been no past scenario where you would have even drawn down your $875,000. Very few scenarios, only in the absolute worst years, and even then, there's no way it went to zero. It's absolutely in the
past. So what
past
kind of an asset
impossible.
allocation would you have then in the, it sounds like you're talking about me taking the Roth first and the...
Nope. The Roth stays forever.
Okay, that's what I thought. So it's actually 435 and 400. The regular.
Oh, I'm sorry. My writing is terrible. 435, but even then, at 5%, you're really darn close. You could pick up the extra work by being a phone rep for somebody for a day. Working from home. So I would really lean more toward that, even if you do draw down your principal a little bit. And have you been to SSA.gov? I'm sure you have. You're obsessive. You've been to SSA.gov.
Oh, yeah.
You know the difference between 67 and 70, right?
Oh,
it's
yeah.
a lot of money. Yeah. That would be my suggestion. And the allocation I'm looking at really depends on your risk tolerance, but it would be somewhere between 40% stocks and 60% stocks, as long as you have the tolerance for that volatility. You need those stocks to make up for the times when there's not enough interest being generated. But that's the way I'd go. Thanks for the call.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information. TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
Well, I want to clear something up. A little earlier I said there was a $20 million minimum investment for Renaissance Technologies hedge fund. That's actually for their institutional fund, which doesn't charge 5% annually and 44% of the profits. No. That fund only charges 1% per year and 10% of the profits, but you need a $20 million initial investment to get in, which not many people have. Their other deal, I don't even know what the minimum is. You can't even get into their website. Literally, you cannot get into their website unless you've been invited. So talk about a special fund for special people. You can't even find out if you're not special. And apparently, I'm not. I hope you are. 855-935. I don't want to be. I'm not. Even if I was special enough, I'm not paying somebody 5 and 44 because you can't guarantee me you're going to get 39% from now on. 855-935-TALK is our phone number. Okay, I guess unless I had $1 billion, which I will never have, I'm not even going to think about it. 855-935-8255. I'm no Ken Fisher, nor do I want to be. Let's see. Ann, you're up next. Welcome to Talking Real Money.
Hello. Thank you for the call.
Hi, Ann. Thanks for calling. What's up?
For many years, I worked for a company that has now closed. I contributed to the 403B and have about $600,000 in that account, but they're closing. So received notification from the company that was managing those funds saying that we need to make decisions about what to do with the funds.
Yep. You need to move it into an IRA.
Yeah. Well, it is in an IRA with them.
Okay.
I'm sorry. They say the one option is to do an IRA with them. Mm-hmm. The other is to, they say, obviously roll it and do a Roth IRA, or go with my current employer if I can use their plan. But they, it's not an option. It's a pension.
They didn't tell you about the other choice, did they?
Those are the options they put on the communication they've sent to us.
They don't want you to know about the third option, and that is to transfer it into an IRA with anybody you darn well want.
Correct.
You don't have to go with them. Who are them, by the way? What's the company that holds the account?
Millennium Trust.
Millennium Trust? Huh. How come I don't know them? I've never heard of them.
They're called Northwest Plan Millennium Trust.
Oh, yeah, here we go. Oh, they're the custodian. What kind of investments do you have with them, though? Yeah, they're just the custodian.
It's a variety of, different investments.
I mean, are they low fee, index products?
Yeah, pretty much.
Okay. I mean, I'd have to look at what they are offering. If it's properly diversified, if the fee structure is good. There are several things that really need to be looked at, and you can't, because you're talking about over $500,000. This is not chump change. This is serious dough.
Right.
You really need to take time and consider this very, very carefully and consider other options. You need to compare them. And that's why there exist these things called fee-only registered investment advisors. And what you ought to do is meet with a couple of companies, see what they think, what you have currently, what other options exist out there, and what might be best for you in your situation, comparing to what you have. A good fiduciary fee-only advisor will tell you, you've got a great plan, leave it alone. If it is in fact a great plan. If it is not a great plan, they will tell you exactly why it is not a great plan. For example, the fees are, let's say, twice what you'd pay elsewhere. They'll give you DIY options. They'll say, hey, you could go to Vanguard, but, and that's one of the things I'm going to tell you. You could just go to Vanguard and get a couple of great funds there. You won't have the kind of management you might need, but you might not need it. I am confident that you could move this into an IRA with Vanguard and pay, I'm confident, dramatically less than you're paying now. And that's at least an option you should look at.
So find some fee-only advisors, sit down and
we got a list of them. Yep, we got a list of them at TalkingRealMoney.com. As a matter of fact, there's a video that I just put up called Good Help is Hard to Find. And it's about how to find advisors, how to pick them, questions to ask them. And then at the end, you can click on a link and it'll show you a number of advisors in the Seattle area that we believe follow the same kind of fiduciary code that we do and believe in investing the way we do. So check that out and do your homework before you make the decision.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, because it's really darned important. Hi, I'm Don. Tom's on vacation. Our phone number, it works 24 hours a day, by the way. You can leave your questions if you don't get through on the show, which airs live most Saturdays from noon to 2 Pacific, 3 to 5 Eastern, 855-935-8255, 855-935-TALK, talk. Charlie, you're up. Welcome to Talking Real Money.
Oh, how you doing, Don?
I'm good, Charlie. How are you?
Okie doke. Well, it's a question about my younger daughter.
All right.
Without getting into family dynamics,
which I don't want to do. This is not a shrink show. No. Oh, yeah.
Well, that's the thing. Well, it has to do with she's changing jobs and is wondering what to do with her 401k in the previous employ, but it doesn't really have to do with in a sense. What she's looking for is because her husband doesn't contribute anything to their retirement. In the event,
okay, we're not going there. We're not going there.
Yeah, no. Well, in the event things fall apart, is either a 401k or an IRA protective?
Okay. No. 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 It still can be. And I'm not a lawyer. I want to make that really clear.
Well, I know that.
However,
I've been listening to you guys for years.
I have been through a divorce many, many, many years ago, and I know from personal experience that retirement plans can be considered joint assets.
Okay.
So, because they were earned during the marriage.
Well, that's the thing. Most of hers wasn't.
But the problem is it's all kind of gotten commingled, though. That's where we run into potential problems. So,
okay.
I don't, I'm not getting into the family dynamic thing, but these kinds of things. I mean, she's got to save for her retirement. Come divorce or continued marriage. And
sometimes
it doesn't
intend to stop. It's just well, it was just a matter of should she, she's not sure she can roll it into her new job 401k.
She can, as long as her new employer allows it, she can roll it into her new employer's, transfer it into her new employer's 401k if she likes it, if she thinks it's really good. Otherwise, she also has the option of transferring it to an IRA with a Vanguard or someone. So she has a lot of options. But the problem is she can't, again, without an attorney being involved, but I'm pretty sure about this, she can't really legally keep those from him. So you just, if push comes to shove, you take your lumps.
Yep. No way to shelter it.
Not that I'm aware of. I mean, there may be some complex legal strategy involving, Cayman Island accounts or something, but not for most of us.
Yeah, you're not talking millions.
Right, exactly. Exactly. Love the Seattle accent, by the way.
I'm on the East Coast.
Oh, okay, good. You're calling me from the East. Where are you calling from?
New Jersey.
New Jersey!
I'm a Jersey boy.
I'm going to be out in your neck of the woods sometime in the next month or so. My kids moved to near Lancaster, and I'll be coming in to the city to see my mom. So I'll be going across New Jersey. I'll wave as I go by.
Yeah, well, I'm about 30 minutes from New York City.
All right. Well, that's where my mom lives. Well, thank you for the call. I wish you the best. Take care, Charlie.
Yeah.
All right. Yeah, bye-bye. 855-935-TALK. I knew that wasn't a Seattle accent. 855-935-8255. I have this terrible problem. And it's not that I'm making fun of people. I suck up accents. I mean, when I went to England a few years ago, by the time I was done with my vacation, I was speaking with a British accent. I don't know what, it was even when I went to Scotland, I got a bit of a brogue. They just sort of, I don't know what happens. I go to Virginia and I get that Virginia Southern accent. And man, some of them have it really thick. There's different ones. If you get in southwestern Virginia, it's very, very mountainish. I'm sorry, not going to get into accent talk. 855-935-TALK is our phone number. 855-935-8255. Let's try and solve some of your financial problems and help you deal with your money and make more money down the road. Oh, and one other thing I wanted to just throw in here. I mentioned Ken Fisher earlier, and I said we're no Ken Fisher. What I was referring to, there was an article in Bloomberg a little over a week ago that mentioned that Ken Fisher's firm is getting a lot of complaints. Ken Fisher is the largest registered investment advisory firm, Fisher Investments, in the country. And they are, I think in the world, they manage $114 billion, although they're about $2 billion below, about 5 billion below where they were after he made some race or sexist comments. But that's not the point of this. His firm, apparently, you see their ads everywhere. They're on TV. Every time you read something online, they send out these incredibly thick mailers to people who meet their demographic, like me, apparently. And they must cost. I know, based on the fact that I get a lot of stuff printed, these have to cost $20 a package to send out with the postage and all and the printing. And then if you succumb to one of their pitches, if you get that free guide on annuities or, on income or whatever it might be, then you get on the list. And apparently, at least according to Bloomberg, that list gets you called a lot. One guy in Pennsylvania in this article says, calls repeat, and he did this all in caps, calls repeat every day. I submit a complaint every day. No corrective action taken. What can I do? This is a guy who complained to the FTC. There was one case where they called a dead guy for 3 years. For 3 years. And a lot of people, of course, Fisher Investment says, if you call us and tell us to stop, we take you off the list. But a whole lot of people say they don't. They call it harassment. They even said that they call you if you're on the do not call list. They make calls. This is from the FTC's report. Calls pretending to be government, business, family, or friend. And this is just awful. This is why our firm doesn't harangue people. We just don't. You know, people, I don't blame you. When we say you could go to our website and you can watch free videos and get stuff and even, meet with one of our advisors for a little while. You can't meet with them all the time. We have to charge you for that. I'm sorry. We're not doing it for free. But we will do that for free, and that we won't bug you. This is one of the reasons why I say we won't bug you. I get it. I get it as one who's been bugged. And I get it that Ken Fisher needs to bug you, apparently, so that he continues to be a multi-billionaire or an even more billionaire. But Tom and I don't aspire to that. In fact, we've always aspired to make a living. Not rich. I promise you that. 855, I got a mortgage. 855-935-TALK is our phone number. I drive a Nissan. 855-935-8255. Give us a call. We'll talk about your life and your money.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And as I mentioned to a caller earlier, we've got some brand new educational videos up at Talking Real Money. Just click on the guy with the TV head. You'll know when you see it. We've got one on finding fiduciary advice called Good Help is Hard to Find. One on creating income in retirement called Retirement Income from Your Savings. One on investing and just how it works and how it has in the past. And a lot more. Go to TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.